Yeah, ready when you're. Okay. Good morning, clients and trading reps of Phillip Securities. Today, the research team will give our usual weekly outlook on the markets and a stock feature, which is Quartz Asia, which we initiated on today. I'm Joshua Tan, Head of Research, and I will be giving you the outlook on markets. Our usual disclaimer. I suppose on everyone's mind is Cyprus, right? Okay, so let's just go through what happened with Cyprus. Initially, there is a conditional 10 billion Eurozone IMF deal, which is conditional on Cyprus coming up with 5.8 billion by itself. Estimates actually see that another 1.5 billion is probably needed for budget deficits going forward over the next 3 fiscal years. Well, the total bailout is going to be, or rather the total amount required is going to be 100% of GDP. The money is needed to recapitalize an insolvent banking sector, which is about assets 17 times GDP. So that's pretty high. Sorry, 7 times GDP, which is pretty high, which is twice the Euro average. And it actually is a result of the massive hit that Cypriot banks took from Greek bond haircuts. Okay, so this initial 5.8 billion was originally to be raised by a one-time levy on depositors, which was 6.75% on deposits between 20,000 to 100,000 euros and 9.9% levy on deposits above 100,000. Now, this was swiftly rejected by Parliament last Tuesday, which has caused a last-minute rush, as usual, to a new deal, with the Troika insisting that Cyprus still come up with that 5.8 billion. So we're still going down the route of a one-time levy on deposits, and at this juncture, the deal is that there would be a maximum 40% levy on uninsured deposits, which are greater than 100,000 at a bank called, nicknamed Laiki, actually it's called the People's Bank of Cyprus. And that bank is the loss leader in the banking system. It will be closed down and all the good assets will be transferred to the Bank of Cyprus, which is also harboring some losses. And the combined entity will be such that uninsured deposits of over 100,000 will be levied to a maximum of 40%. Last night there was also talk of a 4% levy on uninsured deposits greater than 100,000 at all the other banks, including the foreign banks. We put a question mark there because talk of this has kind of disappeared, so we're not sure whether it's still on the cards or not. If you take a ballpark estimate, well, there's 38 billion out of 69 billion deposits in the Cypriot system are above 100,000. And if you take the share of the deposit market that the Bank of Cyprus has, maybe you add some for Laiki, the ballpark estimate comes up to be 4.2 billion between the two of them and maybe 1.1 billion from the other banks if the 4% rule goes through. Okay, so this takes us closer to the 5.8 billion required, and we're happy to say that this morning when we estimated that the 20% hit on deposits was probably not enough, it turns out we were right, and that 20% has been raised to this 40%, if you've read our morning commentary. Okay, bottom line is that foreigners are going to take most of the hit with the Russians, bearing the brunt of that, holding 24 billion of deposits. Capital controls are in place to prevent capital flight, and at the end of the day, we have kind of avoided a Greek debt restructuring style that we've had last year, and a default is staved off, so there's going to be no Cyprus exit from the Eurozone. Some of you may also wonder why bondholders were not hit in this exercise, which seems rather unfair to skip the bondholders and go straight to the deposit holders. Well, actually, we found out that that's because the European Central Bank and many of the other central banks hold Greek bonds, government and the bank bonds as collateral, right? So if those take a hit, then the central banks will be undercapitalized. Right, with this development at Cyprus, we actually think that markets might be a little weak going forward, although they have reacted positively today. We'll go over the short-term outlook in the next few slides, but right now, we just want to go through the fundamentals again of the global market. We're still overweight equities, market-weight bonds, market-weight commodities, and underweight gold. If you look at the U.S., production investment side of the economy are still pretty strong, which is industrial production, core capex, housing, trade, and these are stronger than consumption, core retail sales, and income. We think the first half of GDP growth for the U.S. will be weak, mainly due to the payroll tax hike, the sequester. The second half will be stronger. In China, the HSBC manufacturing PMI preliminary reading has picked up for March over February, so we think China A shares could have a rebound. And the Eurozone, only Germany is recovering. PMIs there indicate that Germany is still in expansion territory, whereas the rest of the Eurozone, France, Italy, Spain, are still in contraction territory and not actually getting better. Okay, so fundamentals there are not good, and that will feed back to the fact that the overall debt levels there are still growing, but GDP is not. Okay, and that poses a macro risk. Italy is also in a political gridlock, and of course we have Cyprus. ASEAN last week actually entered a bit of a correction mode across the board, and we'll go through that, the technical outlook in a couple of slides, but the fundamentals are still positive. So basically exports from Northeast Asia and ASEAN are generally rising on intra-Asian trade. There's a slight worry at the back of our minds concerning inflation, as many ASEAN countries are still running wage inflation policies. Now, for the US, watch out for a possible correction because we have a bearish divergence that has formed. Higher highs for price, but lower lows for momentum. The MACD at the bottom, you can see the two red lines there showing a divergence. So we could have a possible correction. Japan is stalling at resistance, so we think that it will likely consolidate from now till the 4th April meeting, BOJ meeting, which the market hopes will be dovish. Okay, China A shares, like we said, has rebounded somewhat of the 2,500 support, and PMIs have improved, so we think that the correction is probably over, and markets are anticipating reform. Our overweight on China is predicated on reforms this year, and I think the market is generally looking at that as well. We need to see a greater equalization of incomes between the haves and the have-nots in that country. For the H-share market, the rebound signals are less clean, but we are at the 11,000, and therefore that is a support it's a rough support level, which is actually quite messy for the H-share market. So we could rebound on short-term momentum, but overall less clean signals in the H-share market. Same thing with the Hang Seng. At support zone, but could rebound, but the technical signals are not as clean. Right, for the STI, the 3,300, which is the cycle high, is proving to be very strong resistance. We have made a few attempts already to go higher, but they have been failures, and so we're wondering if a correction is starting to set up. I think key thing is to watch out for the 20-day moving average. Should it cross under the 50-day moving average, and that would be a signal that impending weakness is a possibility. For the KLCI, we're still oscillating around the 200-day moving average. Wait for a break in either direction. It's pretty much a wait until after elections play for the KLCI. Okay, for Thailand, we've finally had a significant correction, and it's been a long time coming. Fundamentals for Thailand have not changed. Very resilient domestic story, especially in the investment side of the GDP equation. Our Thai equity strategists still forecast 14% earnings year-on-year growth, and we're still positive on Thailand. We on balance, we view corrections as a buying opportunity. Indonesia. So Indonesia has put in a mini top of some sorts. If you look at the on the extreme right, with Friday having a strong candlestick on the negative side. So odds on we have a bit of a correction setting up. I'll now move you on to Ken, who will talk about Quartz Asia.
Hi everyone, this is Ken here. Today we'll be talking about Quartz, which we have just initiated this morning. Okay, so how we're going to go about this is that we're going to talk a bit about the brief background, the investment merits, the key upsides, downside catalysts, and our valuation on why we recommend buying Quartz. Okay, on a brief background, the company Quartz Asia has IPO'd on 15 October 2012 with an offer price of 0.77. Right now the price is around 0.99, and for Quartz, the first Quartz opened in 1974 in Singapore and entered Malaysia in 1987. So as you can see, Quartz has actually been in both Singapore and Malaysia for some time. Quartz also intends to re-enter Indonesia with the opening of a mega store by FY 2015. As of third quarter 13, it has which is December 12. There are a total of 13 stores in Singapore and 59 in Malaysia as at third quarter. The two main sources of revenue would be from profit from sales of goods. This would be from four categories, namely electrical, IT, furniture, and services. And also at the same time, they also earn service charge income from the in-house credit facilities. Just a very brief on the investment merits before I continue in detail. Quartz is actually a consumer play. So if you believe in the increase in consumer spending, and if you think that they are going to do well in the credits segment for Malaysia and Indonesia, and also with the rising affluence, then we would strongly encourage you to buy Quartz. So moving towards the details in Singapore, we see the consumer spending increasing from four key areas. Firstly, there's going to be an increase in population, up yearly to a yearly increase of 86,000. This is based on the 6.9 million projection for 2030. Also, there will be an increase in spending ability. Also, if you look at the chart on your right, you can see that the median age is around 38.4, mostly working adults, and therefore in Singapore, most of the population are able to afford and have high purchasing power. On top of that, there are also positives from the budget 2013. As you can see below, the wage credit scheme, we are likely to see increase in wages as the government co-funds 40% of the increase in wage up to $4,000. Also, there is also the rapid technological innovations in which you see, for example, the coming Samsung S4, and you'll see TV technologies getting better from plasma to LCD, LED, and OLED. So with all these technological advancements, you're likely to see people replacing their products quickly instead of waiting for them to spoil before we purchase a new product. In the fourth area would be the increase in housing unit. We are expecting to see an increase to 200,000 units by 2016, and with this larger base of housing, the increase in consumer spending is likely to go up. And also, besides the growth of in sales of goods, we are also likely to see earned service charge income from credit facilities, providing additional resilient revenue in Singapore. In Malaysia, the sales of goods in Malaysia credit mix is actually much higher as compared to Singapore, and we expect to see resilient earnings from these in-house credit facilities. This is from the higher mix of credit sales once again, and also from the low bad debts. From the chart below, as you can see, Malaysia's unemployment rate is consistently low, and this is good because typically you would see a correlation between bad debt and unemployment rate. So as long as the bad debt is unemployment rate is low, bad debt is expected to be low too. Besides that, in Malaysia, the credit facility attracts different market segments, both the lower and middle class. So people are those that can afford and have the cash would be able to purchase on cash, whereas those of the lower class, should they want to, they can also take on the credit facility and therefore be able to purchase slightly more expensive equipments. Malaysia will be able to grow revenue from opening of new stores. Right now, there are 59, and management has previously said that they would like to grow 6 stores a year. In Malaysia, they are currently undergoing a review to improve cost efficiency, as current cost-to-income ratio is not as ideal. This review to improve cost efficiency is also in Singapore, but Malaysia is expected to benefit from it more. Other investment merits for the group is that marketing expenses as percentage of revenue is expected to decrease. This is because there will be a limit as to how many pages of the newspaper they are able to market in for it to be effective. And other expenses are expected to be stable or lower as there is higher efficiency. Another merit would be the experience management. The CEO and CFO has been with the company since 1993 and 1996 respectively, and with this they have actually been through the challenging times in courts, and they are better able to manage courts moving forward. The e-courts also has an e-courts platform, an online platform, and this increases convenience to customers in the sense that you are able to go online to check on prices very easily, and therefore this will attract more people to buy from courts, especially since the prices on courts is very competitive. Courts also focus on innovative retailing concepts such as the sleep clinic, and for the credit available, they also offer insurance options embedded. An example of this insurance option would be that, for example, for some plans, should you be hospitalized for 1 day, they would waive off 1 month of installment payments up to 3 days of hospital, meaning 3 months of your waiver of the installments. And lastly, they also enjoy economics of scale and also high bargaining power. This would be, for example, in the able to getting more attractive occupancy rates in shopping malls. And on expansion to Indonesia, we are overall positive, but this may be bumpy initially. It's expected to be operational by FY 2015. Indonesia is attractive due to its higher growth potential as compared to Malaysia and Singapore. Based on our economist forecast, it will be 4.5% as compared to Malaysia at 4% and Singapore at a lower GDP growth. Also, we expect a strong demand for credit facilities over there, and they also have previous experience in Indonesian market. However, some of the concerns that we may have is in the infrastructure. In Indonesia, it's quite common, especially in the Eastern Jakarta, in which they intend to have the first store, to have traffic jams and floods. However, management has actually guided that they have done research and that people are willing to travel up to 17 kilometers for value buys. Also, we think that credit costs may be slightly elevated initially as courts refine their credit balance scorecard and be able to have a larger database so as to ensure quality customers. So on key upsides and downsides catalysts, the upside would be for, the global economic recovery. Should the economy recover faster, we expect higher sales as people have higher consumer spending power, and also lower loan allowances required as lower bad debts occur. Also, should a very strong performance in Indonesia, this would definitely contribute greatly to the revenue and sales of goods for the net profit for the group. Downside catalysts will Downside catalysts will include the rise in unemployment rates. As mentioned, unemployment rate would be related to bad debt. So should unemployment rate rise, we might likely see higher bad debts. Also, the group may be unable to secure more loans due to over-reliance on one bank, that being HSBC. So should anything happen and HSBC not be able to extend the loan tenure or increase the loan amount, then they might have some problem finding more loans. However, management has actually guided that they are right now looking into increasing the number of banks that they borrow from, and therefore moving forward, this should solve the issue. Lastly, unfavorable government policies on wages and levies may also affect the company. Previously in Malaysia, there was an introduction of minimum wages, and in Singapore, there's an increase in foreign levies. On Singapore specifically, the management has guided that most of the employees are actually non-foreign workers and not on S or E pass. So once again, why buy on COTS? From previous slides, as mentioned, there is a strong growth of consumer spending expected in Singapore. The unique credit offering in Malaysia is expected to attract customers and also offer an additional line of revenue. And we are overall positive in Indonesia. That said, the credit cost management would be key as to the amount of bad debts that may occur. So as long as they are able to manage the bad debt and keep it at a low price, keep the bad debts low and minimal, then you would expect to see very strong and positive results in Indonesia. And also the dividend would be a 30% payout ratio, and we expect the dividend yield to be around 1 to 2% based on current price. On valuations, the target price will be $1.14. This is based on our discounted cash flow model. Weighted average cost of capital at 7.1%, terminal growth rate 2.5%. And for more details, please read our report, which is released this morning. It's 6 pages. Yep, and with that, I'd like to open the floor for questions.
There's a question about comments on Xinghai. Since our last report, there has not been any change in terms of the projects. So the only change is technically the number of shares has increased, and the interest costs associated with the previous convertible preference shares will fall away. We will update on Xinghai once there's any change in the projects or announcement of new projects.
Okay. I'm taking the question from Kai Fai Fong about the Wenzhou property price. Actually, Wenzhou is a city in Zhejiang province, and this city suffers very big property price bubble. And so actually this 50%, it's not within just these few weeks, as you said, it is since 2009. So the case is that the market should have already placed this place this kind of information into their pricing. And so far for China property, although there is still bubble and in general the property price has risen again for the past few months, but we don't see a systematic risk yet. So for this, only one data point in Wenzhou, it cannot represent the case for whole country. As Wenzhou is, as I said, it is one of the cities which suffers the biggest problem in China for the property market. Yeah. Okay, thanks.
Right, there's a question on the support levels for the China A50. So it's bounced off the 8,000 support, and we are at the 8,500 resistance. Our view is that Asia market will go higher. Okay, another question on Cyprus. For Cyprus, what were the consequences if Cyprus collapses? Will the EC market affect us? Yeah, it definitely will. But given the current bailout, I think it's very punitive on deposit holders, especially foreigners. Going to have to foot a third of this bailout, and but it's been done. So the fact that they've raised the money means that they'll get the 10 billion from the IMF and the Eurozone. So the chances of an exit from Cyprus is extremely, it's pretty low right now. I mean, basically we have the same kind of will to see Cyprus stay in the Eurozone. But I think, it could be used as an excuse for some short-term profit taking. Thanks. Okay, questions on courts.
Hi, a few questions on courts. Okay, first of all, why is the trade and other receivables a high portion of total current non-current assets? Is collectible of receivables an issue for the company? The company seems to be draining cash from the cash flow statement with the dividends payout, although at a low level, foreseen to be sustainable. Okay, so on trade and other receivables, on it being a high component of assets, this is because of the credit financing facility. But this is not a concern for us because based on the figures, we can see that the amount of bad debt has actually been very controllable and has been decreasing over the years. This is because of a very good plan in a very good. There is a because it's able to manage their bad debts. This is through many ways, such as, for example, they have a very good way of detecting clients who are not customers who are not there to really buy the products, but rather for other ill meanings. For more information on this, you can take a look at our report. But that in overall, there is not much of an issue in terms of bad debt collection. On cash, it's true that cash is being drained from the cash flow because of all this lending. However, this lending are actually at very attractive net interest margins. In Singapore, it's more than 15%. So this net interest margins on the loans and receivable are actually very attractive, and therefore, even though it's cash draining, it is positive overall. And on dividend payout, right now, this dividend payout we expect it to be likely, and also we actually expect that this could increase moving forward. This is because the courts model is very low on capital expenditure. The suppliers actually helped in payments, like subsidizing up to 50% of the renovation costs, and because of this subsidy from the suppliers, therefore the courts capital requirements are actually very, very low, and therefore it could actually increase once the operations in Indonesia has stabilized more. Another question on courts would be on whether they lease or own the retail shop building. Most of the buildings are actually leased. However, this shouldn't be a problem because in most of these areas, they are a key tenant. Therefore, the anchor tenant, and therefore they have very attractive rates. And should rates not be attractive, they'll be able to quite easily shift to another building, and this has actually been done quite a few times.
Hi, good morning. This is Derek here speaking. We got a question on NOL and also our view on them. If you recall our last report on the 25th of February, which was the full year results announcement, the company actually reported a negative earnings surprise, largely due to lower than expected increase in freight rates relative to our expectations. So the big picture story is that we think that we are probably at or even near the bottom of this whole shipping cycle. If you look at various indicators, the shipyards are quite hungry for orders. The new orders that actually cause the supply glut that we are seeing now are gradually being delivered into the market, and the order book at the shipyards are coming down. So that, I think, is an indicator of better times ahead. But that said, we don't think it will stage a strong rebound, because ultimately, fundamentally, the supply-demand situation is still unfavorable. Supply is still fairly high for the entire container shipping industry. So we are still cautious. We rate NOL as a neutral with a target price of 132. I'll hand over to Nicholas, who will talk about Wilma.
Hi, with regards to Wilma, we noticed that there's a slight decrease in its share price over the past few weeks due to issues related to the China inflation, which we see some increase in inflation. This may have caused the decrease in share price as sentiment feels that there may be the China government may come in to regulate the cooking oil price again. But having said that, we feel that this should not be an issue, because going forward, we feel that the cooking oil price will still be the China regulators will still not regulate the cooking oil price going forward. With regards to the palm oil price, yes, it has come down a lot, now trading around $800 US. This will in turn affect its palm plantation segment. But having said that, Wilma has the whole supply chain in itself. We got the palm and lauric business and crushing business. So all in all, we feel that for Wilma, it is still kind of like diversified in a sense. We remain, but in the short term, we remain cautious for commodity stocks. Our target price for Wilma remains at 379. Thank you.
Hi, thank you very much, everybody. Thanks for being with us this morning. And there be no more questions today, so we will end our session here. And just to update the audience, we have increased the capacity for this webinar from 100 to 500 packs. So you may invite your friend or clients to log in as well. So I think that's about it for today. Thank you very much for joining. See you next week.
Hi, Dennis. If you're still on, you're asking about the is there possibly a more Cyprus, right? The answer is actually yes, because Italy is still a situation that needs to be sorted out. Basically, if right now that Parliament is very fragmented, we could see a possible rollback of the austerity measures that have been implemented for Italy, which, if you recall, Mario Monti did a very good job actually stabilizing Italy's situation, okay, with tight fiscal austerity and actually putting in a primary surplus in the budget, which was a commendable effort. Unfortunately, we've had a change of government that has had no clear winner, no clear direction. So if these reforms get rolled back, we certainly could see further problems with Italy. Okay, so overall, Eurozone, the underlying dynamic is that debt is still compounding faster than GDP. And that means it will remain a macro risk until it finds some growth. Okay, thank you.